following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and I don't know about you guys, but I just love that theme. It really just gets me in the mood for some options education, some boot camping, if you will. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And allow me to welcome you to this episode of Options Bootcamp, the program where we take the raw retail options recruit and we break you down and we rebuild you into something bigger, faster, and stronger, and hopefully something that's better at options, but we'll see. At least the first part. And I am joined today on the old Options Bootcamp program by my fellow drill instructors, starting off with the man from the Market Taker Mentoring, none other than Dan Passarelli. Dan, welcome back to the show, sir.
Woot, woot. Yeah, man, I'm here. I'm ready for a very exciting show today because we are doing some really exciting stuff. You know, guys, we talk about this stuff before we come on the show. I know it seems perfectly seamless and natural and ad-libbed, but we plan our shows a little bit. And we have got a great one planned today, and you're going to love it.
There was planning involved? I must have missed that. I missed the planning. I missed the weeks of planning session and the detailed scripting involved. But I also love tossing it to you, Dan, because I just never know what's going to come out of your mouth when I first invite you on the show. So that's one of my favorite parts. One of my favorite parts of the program. What's Dan gonna? What sound effect is going to issue forth from him today? I'm gonna get you a whistle one of these days. I would just keep waiting, maybe for the holiday season as it approaches for us. All right, and also joining us on the old Options Bootcamp Drill Instructor Squad is none other than John Critchley. He is the options specialist over there at Sogo Trade. John, welcome back to the program to you as well.
And thanks for having me back, Mark. Post-Sandy, a little recovery here. We were lucky that we had no issues during Sandy because we have some redundancy in our Midwest data center. Although myself and some of the other department heads are based in New York, we have offices in St. Louis and Los Angeles to handle the overflow. So we made it through post-Sandy okay, although some of the employees here had some damage to houses and trees and property, but we're doing okay now. We're hanging in there.
Yeah, it's important to mention out there for the listeners that you guys did indeed have your data centers outside of New York, which is a good thing, and not just in the data center in New Jersey across the river, but actually out there in St. Louis. So you did have a little bit of a wide berth from Sandy, which was nice. You saw a lot of firms post 9/11 have made their disaster plans, but they planned for a very localized urban terrorist type event where they moved their data centers and the bulk of their operations from Manhattan over the river to New Jersey. And that's good for a localized event, but when the storm is 500 miles wide, it doesn't exactly work, and as we saw with the markets closing everywhere. So it's good to hear that you guys weathered the storm, pun intended, and that we're able to maintain operations and to keep everything running ship shape during the storm. So good to hear that, John. And now that the team has been fully assembled and our caps are donned and our whistles are at the ready, we're going to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, and welcome to Basic Training. This is, of course, the portion of the show where Dan and John and I walk you through some basic options concepts, some educational topics, some interesting things that are good for a brand new retail options trader to learn. And we did a show recently, and a lot of you may remember, it was a very popular, the Busting Options Myth Show, where we kind of sat down and walked you through some of the common options myths and misperceptions that float around out there we hear from a lot of retail options customers. It was so popular, and we got so much good feedback on it, that we decided to do it again. So today we're going to do part 2 of our Options Mythbusters non-TM episode. And looking through the list, I was joking with Dan earlier, we do indeed do some planning for this show, and we were thinking about different myths and misperceptions that we could bust on this episode today. And one of the ones that seemed to occur to pretty much everyone almost simultaneously is this first one we're going to discuss. And that is, there are variations on this theme that you hear from different people throughout the retail world, but it seems to mostly boil down to this, that somehow the market makers out there, they know where the orders are working, where all the orders are, and they're looking to essentially they're just going to take advantage of the retail customer, and that's what market makers are out there for. They're out there to nickel and dime you literally, and to make sure you get the worst execution, and to make sure they take as much money out of your pocket as possible. And it's interesting, this myth pervades for quite a large amount of the retail audience. I've never really understood it personally. I think part of it is just the lack of understanding of the basic execution methodology and what is involved, the arcane minutia in some ways that is involved these days in actually executing an options trade. But there is a grain of truth to that belief, and that the fact that market makers are not charities, they're not altruistic entities. They're out there to make money. So they are out there looking to make the tightest markets, and also to make the most money per trade as possible. So that part of the myth is true. But intelligent market making firms, and this has been the case from day one, as soon as I walked onto the CBOE, which was years ago now, it was the smart market making firms, the large firms, the intelligent firms. They understood the value of order flow, particularly of retail order flow. They all want to be next to retail order flow. It's great order flow to interact with. So you have a lot of them out there who would really bend over backwards to execute a retail trade where you wouldn't see that on an institutional type order. So you will get price improvement. You will get a lot of extra efforts on the part of the market makers to execute a retail trade at a favorable price versus a large institutional block order, let's say. And the reason for that is quite simple. The firms know that you, the retail customer, are the lifeblood of this business. And they know that you're coming in, you're putting on a 10 lot or whatever, and you have some economic interest in doing that trade and getting that trade off at a favorable price. So if they could incentivize you a penny or so here or there, that really is no real skin off their nose, and it allows you to get a better price, you get a better fill, you have a better experience. Hey, you'll come back again and trade options again. That's what really is their end goal of the market makers, of the brokers, of everyone, the exchanges. They want you to be a repeat customer. So if they're out there squeezing you to death every time, that really isn't a long-term viable business model. So you could be as Machiavellian, as draconian as you want to be in your own thought process about thinking about market makers and how evil and how much they're out there to squeeze and nickel and dime you. And even if you believe that still is, at the end of the day, it is in their best interest to give you the best fill most of the time. So in that sense, they have a vested interest in keeping you happy and keeping you executed and keeping you coming back to the options market. I mean, time and again, that's one of the reasons we caution so many of our listeners against coming in and just wasting all their money on out-of-the-money lottery tickets, because the payoff potential is terrible, and then you burn out on options, you get upset, and you never come back. That's a great way to lose a repeat customer. So market makers know that. They want to incentivize you, so they will usually go out of their way. The notion of the market maker as this great, large Machiavellian schemer out there to steal pennies out of the pockets of all the retail customers, it really is. It's really just kind of one of those kind of boogeymen that retail likes to conjure up, I think, to blame for some of the other errors that are going on with their trading, poor strategies, poor execution, what have you. Now, I know Dan and John, you both have a lot to say on this topic. Maybe we'll start with you, Dan. What do you think about this whole boogeymen of market makers?
Yeah, the thing is that people always fear what they don't understand. And the perception, of course, of the professional trader is sort of the master of the universe, in the bonfires of the vanity sort of way, where they're just sort of this untouchable, person who just prints all this money and they know everything about everything, and they, and it's just not true. I mean, I and all of us here on the show have been professional traders in the past, and hey, look, we're just regular guys. We
speak for yourself, sir.
That's right. Well, I'm a regular guy, but I mean, we just went down to the trading floor, carved out our future, figuring out how to trade as a professional. And see, the thing is that professional traders trade differently than retail traders. Not necessarily better or worse, just differently. And this is something that we probably mentioned on the show in the past. This is something I spent a lot of time in my book, The Market Taker's Edge, talking about, is that professionals trade volatility, retail traders trade direction. And because there's two different forces trading the same product differently, it creates natural inefficiencies, in my opinion. And so really, the market maker is the retail trader's friend. The market maker helps you, and vice versa. The retail trader helps the market maker. It's a very symbiotic relationship. And, as far as the ways that they kind of work together and synergize and are symbiotic, that's fantastic. In the very small ways that they compete, it's one of the least relevant parts of your trade. The only thing that the market maker is competing with the retail trader on is the bid-ask spread. That's it. That's the only thing you guys are actually in competition with a professional trader on.
And John, what have you to say on the whole market makers are evil boogeymen topic?
Well, I mean, this to me is just patently false. Up until 1999, there may have been a grain of truth to this statement, because the options were single listed. They traded only one place. The markets, therefore, were wider. And starting in 99, the options became listed on more than one exchange. And then the fight became, at least on the floors, for order flow. So what happened was Apple, for example, was traded only on the Amex, IBM only on the CBOE, Dell only on Philadelphia, etc. But once these options are traded now in 8 or 10 different places, the competition for this retail order flow is fierce. And going back to what Mark said, the market makers are your friend. They want you to come back. And with penny increments, all you have to do is look at the Spiders markets, or even Apple. Look at the tightness of the markets. So we now have multiple exchanges, electronic marketplace, and very, very tight markets. And this whole idea that market makers are evil is really, really not true. Options, as we all know, are not a zero-sum game. If I buy an option and you sell an option, we can both make money. And market makers know that. They want you to come back. So just be aware of that, and just know that when you put an order out there, that the execution you get should be a fair execution.
And another point I want to make on that notion too. I think some people ascribe these these evil intentions and motivations to market makers. And you're right, Dan, it is somewhat out of ignorance of how the markets actually work. People fear what they don't understand. And a lot of it is just, your average retail trader, they'll see a spread. Let's say it's a dime wide or 20 cents wide. Guess what they want to do? They want to come in right at the middle of it. And they expect for some great charitable reason, the market makers are going to execute them there. They have a spread that's 20 cents wide. They come in right in the middle. Guess what? The market makers, typically, they know you're going to do that. So the notion that you're going to get this fill every time right mid-market, and if they don't do that, they're somehow squeezing you or nickel and diming you. That's just the way it works. Their bid and offer is posted there for a reason. That's where they really want to execute. Typically, the real bid and ask is a few cents around that usually, and you could see that if you're executed on some exchanges that offer price improvement. But so you might be able to participate in that from that sense. But if you come in mid-market every time, and then you're upset because you're not getting filled, and you're turning towards the evil market makers as the culprit, I would say look at your execution style instead, because there's more people out there who want to execute mid-market than just you. And so just because you're not getting it every time doesn't mean the market makers are evil and are the enemy.
Mark, I just wanted to say one more thing about this real quickly. And this is a fact, and Mark and Dan knows also. There's only a fraction of the number of local traders, independent traders like I was and Mark and Dan was on the floor right now. And that's just an indication that the markets now are so tight that it's hard for a local trader, independent trader, to make a great living or a good living down there. So that might be bad for the independent traders, these tight markets, but it's great for retail.
All right, moving on to our next myth/misperception is one we've touched on a little bit on the show in the past, and in fact on many of the shows here on the old Options Insider Radio Network. We've said many times that a lot of retail customers come to options and they start off buying a call. Sometimes they'll buy a put. Usually they'll buy a call, and then they'll migrate and expand their trading strategies from there. They'll look at the spreads, and then eventually a lot of them will turn towards the, as I like to call, the dark side of selling premium. They start realizing how theta works and other aspects, and realizing that theta is a high probability trading strategy for them, and they like it, and they start falling into that routine. And we've discussed that many times about how professional traders tend, for the most part, to lean short premium and like to collect decay. That's just kind of just the way the market shakes out. But when we say that, we shouldn't. Maybe we're partly to blame too for creating this misperception that the only way to really trade profitably is to be a dark side short premium trader. That all you can do is sell options all day. I know when I first walked on the floor of the SIBO, all the old timers were out there, and there were two expressions that were ubiquitous. And Dan, I'm sure you've heard these yourself. The first one was, when in doubt, palms out. And the second one was options are insurance, and you don't make money buying insurance, you make money selling insurance. And that was a very prevalent mindset in the options marketplace until, I would say, in the last decade or so, where we had a lot of really large swings in the underlying, and people started realizing that just coming in and blasting out premium on every strike across the board wasn't exactly the best trading strategy. So that said, most strategies that we tend to employ, that I tend to employ, I think a lot of professionals tend to employ, do end up leaning short premium, but that shouldn't be seen as some sort of indictment of buying premium or going long options. I mean, that's not to say that that's a bad strategy. It's really a case by case basis. Whatever the situation dictates is the strategy that most reasonable traders will apply. And just when we talk about going long premium, as we said on many shows, review our earlier episodes of Options Bootcamp if you want to hear more about the risks of going long premium. But essentially, just know what you're getting into when you're doing the type of strategy, because it does take a little bit more effort usually for that type of trade to pay off. Things we talked about before, like gamma scalping and other things like that. And Dan, I can hear you champing at the bit back there, because I know you're a big fan of buying premium as well as selling it. So why don't you lend us your 2 cents on this common misperception?
Well, here I'm going to start this out discussing it one way, and then I'm going to basically negate every single thing I say. How about that?
I'm looking forward to that.
The big argument is, a lot of people say credit spreads are better than debit spread, right? And man, in presentations, if I had a nickel for every time I've heard somebody say that. And here's the deal. When people typically trade credit spreads or debit spreads. Both of the options are out of the money. So the operative option, the long option in the debit spread or the short option in the credit spread, is the one closest to the money and therefore has the dominant Greeks effect. So when you trade a credit spread, typically the way people conventionally do it is, it's an income trade. You're short gamma and vega. When you do a debit spread, you're long gamma and vega. Well, here's the deal, man. Selling premium surely does have certain advantages. Time is on your side, blah, blah, blah. And some traders and academics will say that it does have a real inherent advantage where they believe that volatility is historically overpriced, just systematically, which, may or may not be true. I tend to believe that somewhat. But sometimes volatility is underpriced. So traders always need to look at a volatility chart, do their homework, and trade somewhat based on volatility. Maybe just directional trade, but you're still taking a position in vega, and you better make sure that that vega position is a smart one. Every single, there's three things that enable you to make or lose money on an option trade: direction, time, and volatility. I would go as far as saying time's arguably the least important one, because when time's on your side, gamma's against you, and when gamma's on your side, time's against you. It's a very natural trade-off. So really, the two things you need to focus on are direction and volatility. And so many people don't focus on volatility. It's such a big mistake. You've got to put those two things in your favor on each and every trade. Okay, so there's that. But when it comes to debit and credit spreads, here's where I just basically negate everything I just said. Really, there's no difference. Debit spreads and credit spreads are the same thing. At least they are synthetically. Now, how they're typically traded, with both options out of the money, okay, they do have opposite Greeks characteristics. But an out of the money credit spread is the exact same thing synthetically as an in the money debit spread when you use the same strikes in the same month. So, typically when people say, well, this strategy is always better than that strategy, it really comes from the fact that they don't really fully understand what it is they're trading. And, they kind of heard somebody tell them that this particular strategy is better than another one. They just kind of glommed onto that and stopped thinking. In options, you should strive to always be learning, always throughout your entire career, and to continue getting better at it. And, I think the people who glom onto one strategy and say, well, this one's always the best, they just kind of got lazy and, just kind of stopped moving forward and improving as a trader.
I like you're busting many myths at once there, Dan. I like with the strategies and the credit spreads and the selling and the buying. So maybe we'll dial it back a little bit for our listeners and hit on one at a time. We were kind of getting in there. Let's finish up first on the long premium versus short premium, and perhaps even flip it on its head a bit. I know, John, you have a lot to say on this topic as well, and maybe we'll also, because the flip side of that belief is that, of the flip side of the belief that buying premium is this evil thing, is that selling premium is this fantastic way to always make money, and those are both really incorrect beliefs. And sure, John, I'm sure you encounter both sides of this coin over there at Sogo.
Yes, I mean, what I wanted to bring up in this discussion is that, with equities, we have the old adage, diversify your portfolio. Well, why not in options if they're going to do it in equities? So we always tell our customers, you should become familiar with different approaches. If you only sell options, one day you may blow up. We've all seen it. And we have customers that if you only buy, one day you may lose all your money. It could be either a slow death or an instant death. So we always stress to learn about as many strategies as you can. And for example, like on our site, we have a dedicated strategy section, which I helped write, and that describes about 25 different strategies. This section contains the market view, if you want to put a certain trade on, the level of proficiency that you need to put the trade on, the tactic, the risk reward, and there's also a graph of the P&L graph of the trade. So this allows a rookie or a newbie to go to this section and look at the different trades and see how these different trades may fit what their their style is or their risk tolerance is. Again, the beauty of options is they're very flexible, and if you just hone in on one strategy, I think eventually in the long term, either you're going to blow up or you're just going to slowly wither away. So try to be more flexible and use multiple strategies. Maybe a credit spread is great for you one day, next day a debit spread. So just try to learn as much as you can and educate yourself, and that would probably be a very key thing to being a great trader.
You mentioned that single strategy thing that Dan hit on as well, and that's another common misperception we see with a lot of retail options traders. This has been very prevalent, I would say, over the past 5 or so years, particularly since we launched Insider. We've seen so much love, so many services, so many people jumping on board the Iron Condor train. That's probably the one example that comes most to mind right now in terms of the single catch-all strategy. We see a ton of services out there, all about, and newsletters and gurus all out there hawking the selling Iron Condor strategy. It's this catch-all, this panacea. It's this fantastic strategy that works in all these different environments, they say, and it's a risk limited. And there are certain truths to that. It is a risk limited strategy, but at the same time, that gets back to what Dan and John were just saying, where if you just specialize in one strategy, there are certainly environments where that one strategy is not optimal. And in an environment right now where we've seen vol come off for the most part over the past 6 months, writing Iron Condors time and again and really forcing that right in situations where you probably shouldn't be just to collect that premium is not an ideal strategy right now. And premium harvesting is becoming a more difficult strategy in general right now. So you have to really pick your moments and pick your battles. So if you're one of those traders who leans towards one strategy, then you are doing yourself a disservice in the long run. Markets change, environments change. You need to have the tool set and the arsenal to be able to adapt and respond alongside those environments. And that's why you listen to a show like this, and that's why you listen to the other shows on the old Options Insider Radio Network, and you go to sites like Dan's, and you go to the education section of sites like Sogo to arm yourself with those tools so that you can be the type of trader who can respond to different market environments. And now there's so many other myths that we've looked at and that we've seen over from retail over the past few years. I know that you've seen, John, that you've seen, Dan, with your clients, and we've certainly heard over here at the Options Insider. And I think maybe we'll jump to this next one, because this is kind of the heart of this show. The reason why we're doing is this myth perception here, the belief that, and this is not limited to retail. I see this with a lot of customers who should know better. Professionals, money managers, asset managers, financial advisors. They all share this belief with retail, a lot of retail anyway, that options are somehow too complex, too risky. They shouldn't be executed unless they're by professionals who are very seasoned in them. And that's just a ubiquitous belief. And like I said, it's growing, actually, it seems like, with a lot of the money manager, asset management crowd. Whenever I go to these types of mainstream financial advisor conferences, the options discussions and material is nowhere to be found. And obviously, a show like this is a first step in correcting that belief, that misperception, because the options are indeed suitable for a wide variety of retail clientele. And that's why we have this show. I mean, everything we've talked about since episode 1. The whole notion of hedging risk with options. I think it comes back to really retooling your mindset, retooling your perception of options as this risk additive tool, and instead seeing them as they really are, which in proper circumstances are risk mitigating tools. That's how they were designed. That's how they were intended to be used. And hopefully that's what we've taught you here on this show over the past 11 episodes, that you can add options to an equity portfolio and use them to control risk, to control volatility, and in general improve the risk management of your portfolio and improve your returns overall. Now I know Dan and John, you're both excited to get in on this one. Maybe Dan, we'll start with you. This notion that options are too sophisticated, too complex, too dangerous for Joe Retail.
You know what? This is a great story. Like you pointed out, Mark, not just Joe Retail, professionals too. So I started my career as a trader down on the trading floor, and the first trade I ever made was as a professional. That's sort of my background, and I didn't really know too much about any other part of the business except for the trading floor business, when I first started, because that was my only exposure. So then I went and I started teaching classes for one of the exchanges. And this was my first voyage into teaching, and I was just kind of learning what that was all about. And one of the first classes I taught was for some institutional traders, and it was an all-day class. And, I'd never done any of this before, and I was given the PowerPoint slide deck to teach, and I was looking at it, and I was like, what is this? This is all covered calls, this is all this basic stuff, And I was sitting down at breakfast with this guy who managed, if I'm not mistaken, it was like $1 billion, like a huge, huge amount of money for a major bank. And I'm sitting there talking with him, and, he's talking about some of the stuff he does and some of the stuff he looks at for choosing stocks. And I'm thinking to myself, oh, my God, I'm going to go and tell this guy about this totally basic thing. He's going to eat me for lunch, He must know so much more than I do because, he's managing $1 billion and, this is all I got to teach. I've got to teach this. Ugh, what am I going to do? This is going to be terrible. And so I spent the first 2 hours talking about totally basic option stuff, how to manage risk with options, covered calls, and protected puts. And that's it. That was the first 2 or 3, probably 3 or 4 hours, all the way up until lunch. So then I'm sitting down at lunch with this guy, and he goes, oh, my God, thank you so much for showing me this. You really opened my eyes to a whole new world. And I'm like, really? It was the first time that I really understood that the typical investor out there, even the big, huge institutional guys, don't really understand options. And that was sort of a big turning point in my career as a teacher and somebody who wanted to go out there and evangelize options. These guys need to know this stuff, and they don't.
And that could be another misperception maybe we'll add to a later show, that belief that institutional / advisors / what have you are very skilled and versed in these and know better. And as you learn through that, and I've learned many, many times over the past 5 years, so since launching Insider, that is not the case. They are in many ways less sophisticated than even our basic retail guys coming into this show. They just have more assets under management. In fact, I'd go out on a limb and say, if you're a retail customer and you've listened to all 11 of these episodes and you've become versed in options, then you're probably more sophisticated than a lot of the asset managers out there who are managing substantial amounts of money, which is a scary thought, but yet indeed, unfortunately, it is true. And John, this obviously must hit near and dear to you, the belief that retail is not capable really, or shouldn't be capable of handling and executing options, because if people believe that, they're not coming to Sogo.
I mean, right. I just want to hit on one thing that Dan said. I think it's the leverage that scares the customers. If you're a stock trader, the risk-reward profile of a stock is binary. If you buy a stock and it goes up, you make money. If it goes down, you lose money. If you buy stock on margin, you double this effect. You get more leverage. But of course, with options, you increase your leverage. And I think that scares a lot of or there's a myth there, or scares a lot of the customers, this margin, all this leverage. So that's one thing that we want to debunk, that the leverage is necessarily a bad thing. And the thing about about executing should be only handled by professionals, that comes from an era where there weren't all these user-friendly platforms like Sogo Trades and others that are easy to use, intuitive, and can contain all these trading tools that make the trades so easy to execute and understand. I mean, I for example, on our Sogo Trade platform, we have 20 configurable option chains with predefined strategies. So let's say you like to do bull call spreads. Well, we have you can look at the bull call spread on the chain, and if you want to do straddle, it's the same thing. You can only look at the straddle market for IBM. So it's very easy to fine-tune exactly what you want to do. And if you want to do a spread, it's a few clicks of a mouse. It's as easy as that. So this whole idea that you need to have professionals, do these orders is really a fallacy, and a myth.
That's a good point. That's something that Dan and I have hit on way back since the inception of this show, just how the retail environment has evolved over the past decade or so. You know, the notion of being an active retail iron condor seller 15 years ago, that was a difficult prospect. You had to set up an options account with a brokerage firm. A lot of firms didn't offer them that much. If they did, their functionality was rudimentary at best. You can buy a call, buy a put, a couple other things, maybe some basic spreads. The notion of being able to enter a multi-leg trade like that, you probably had to pick up the phone and call a broker. They had to call the pit and execute it. It was just atrocious. It was slow, a lot of long execution times. It was just a difficult prospect. And fast forward 10, 15 years now, and you're right, John, the platforms have evolved to the point where the things that firms like yours and others out there really offer the retail customer for free, just for opening an account, are borderline ludicrous. They really are professional grade tools. In fact, we joke about the professionals, in quotes, you know, the asset managers and others not understanding options. The tools you guys offer to your basic retail customers are better than a lot of those asset managers and advisors have at their disposal when they want to execute options. So you guys have really, you know, Sogo and all the other brokerage firms have really just created this environment now where if you are a basic retail options customer, it is easier than ever. And the tools at your disposal and the education and the platform, one click, risk reversals and iron condors and things. I mean, it's really, it is easier and cheaper than ever before to be an active and sophisticated retail options customer if you have the wherewithal to learn and to become skilled and versed in options. And you know, there's a lot, there are quite a few other myths and misperceptions that we'd like to discuss here, but I think we're going to have to save those for another day because we're coming down to the wire and we still want to get some of your listener mail here on the show as well. So I think that's going to do it for the basic training segment for this episode. And now we're going to dive right into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and like the man said, it's time to listen to questions and hear the questions and respond to the questions from our listeners. Give you, the listener, a chance to take the reins of the show. And first up, we have a little bit of love coming in via email from Alan Donson, and he writes, "Your format is excellent." Thank you, Alan. "Please add more pure options trade content." Well, we're working on that, and you know, if you want that, there are also a lot of other shows on the Options Insider Radio Network, like the Option Block and others that do a lot of active trade analysis and things like that you may be interested. Alan goes on to write, "And also please feature John Critchley." So apparently, John, you have a fan. And he also goes on to write, "Your intense focus on real options information with a view toward options profits, not tedious theory, is highly appreciated." So thank you, Alan, for that. And John, what do you like to say? What do you want to say here to your fan writing in who wants more John Critchley?
Well, I want to thank my Uncle Alan, first of all. No, but, you know, the idea, the recommendations on my end is very tricky from a regulatory standpoint for us. At Sogo Trade, we deal with customers that are self-directed. We may lead you to the water, but we can't really tell you how much to drink or, you know, when to drink. So we try to educate our customers to make the best decisions that they can. And if you read some of the articles I've written and many of the great articles on the optioninsider.com, you'll see a lot of times I'll say something like, if you believe this, then consider maybe doing this. And it's just really hard for us to make pure recommendations, you know, to our customers, because there's a regulatory aspect that we have to follow, and we are not allowed to do that.
Yeah, Alan, I appreciate your feedback, but this is not really the show for that. This is more of a purely educational show, so we're going to talk in theoretical terms. We're going to talk how different strategies perform and different strategies and different scenarios in which you might want to implement those strategies, but we're not going to say, hey, vol is cheap here, this is a good time to be buying iron condors in Dell or something like that. We're just not going to do that. There are other shows out there on our network, and the content like Joe, I almost called you Alan, and there's other content on the Options Insider, like John said, that does do exactly that. But this show is more of a educational and theoretical type of program. Next up, we have a tweet from Really G, and he's commenting on something we discussed in depth last show. Maybe we need to clarify it a little bit. He writes, you suggested a put buy as an ASET to a limit buy order. Certainly not in the gap below strike scenario your guests were discussing. Let me just clarify here what Really G is talking about. First off, the ASET, the ASET he writes about is what I was joking about on the last show as the alternative stock entry tool, as a better name for a naked short put, something that's not as scary to the client or the customer. So that's what he's talking about there. He made a little bit of a mistake. He said I suggested a put buy as an alternative to a limit buy order for an equity. It actually would be a put sale. So you're selling a short put as an alternative to working a limit buy order. And in most scenarios, I do tend to prefer that strategy for a lot of retail because it generates some income for them, and it allows them, if they understand the actual underpinnings of the options market and how this works, to be a more favorable scenario, because a lot of times if they're working limit buys, the stock's going to move away from them. They're not going to get anything from that except for no execution, whereas writing the put at least generates some income. And certainly in the scenario he writes about, in the gap below the strike scenario, would I recommend you come out and blast away at naked short puts? No, that's not an ideal scenario for naked short put selling. And that scenario is going to unfold. And in those scenarios, naked short put may not be ideal because the volatility is going to explode. You may lose even more on the put than you would have just owning the underlying, particularly if it's a very volatile situation and people are really inflating a lot of vol into that strike. So keep that in mind. But I say in general, and I'll open it up to Dan and John too, because I think they have a little bit different belief on this. But in general, most of the time I favor short put as the ASET, as the alternative stock entry tool, because it is a better way for a lot of retail customers to leverage some of the inherent functions of options to generate more returns and in general improve the profitability of their trading over the long term. Now, Dan and John, I know you guys took a little bit of issue with that on the last show. You guys are a little bit more concerned about the gap down scenario. So you guys tend to favor more of the limit buy versus the short put as a stock entry tool for retail. Dan, maybe we'll start with you.
Well, it depends on what you're trying to do. One of the hardest parts of trading anything is the psychological aspect of it. And there are way too many times when I hear traders trick themselves. You know, they hear about the selling a put and they're not investors, they're traders. I think selling puts can be great for investors in the regard that you're talking about, Mark. But traders, they don't want to buy the stock. They just want to sell the put and have it expire worthless and keep the money. That's the trader's objective for selling a put. But, you know, they learn about it and they kind of, learn it, halfway. And they trick themselves. They say, oh, yeah, but, if the stock fell, I'd buy it there. But, when the stock gaps down and you're buying it $10 above where the market's trading because that's where your strike price was and the stock fell so hard, as a trader, you don't want to buy it there. You don't want to buy it anywhere close than there. Now you went from trader to investor and your whole plan is just blown out of the water. So, the psychology thing, tricking yourself into, believing, hey, I'm willing to buy it here, not good. Every strategy is a great strategy under the right set of circumstances for the right unique scenario. And, you got to know what those scenarios are and you can't lie to yourself either.
I suppose that's the dark side to this, using the put as the ASET, the alternative stock entry tool, because once retail gets a taste of that and they start realizing, hey, I can generate this income, they start doing exactly what you said, Dan. They say, man, I'm going to forget about the underlying portion. I'm just going to start blasting out puts left and right all over the place because how can that lose? And that's where it kind of gets to a little bit more of the dark side, as I like to refer it, where they start getting lured in by the siren song of premium selling until it all blows up in their face. And so, yeah, we definitely don't encourage you to go down that road. But as just starting off in the option space, looking to work buy orders in an equity, there are better ways to do that using options. And now, John, I'll let you chime in on this one as well, because I know you were in particular concerned about that gap risk on the last show.
Yeah, I mean, I agree with Dan on this one. As far as the thing that concerns me is the misconception that if you sell a put for a certain price, then you're going to own that stock at, let's say, stock 600, and the strike 600, and you sell the puts for $10, that you're going to own that stock at 590. And as long as the customer is aware that if the stock gaps down, that's really not the case. And that's the only thing that I just like to clear up, with the customers. And as long as they can understand that you're going to buy a stock at 590 when that stock is trading at 550, and that might not be so good. As long as they understand that, I think that selling puts, like Mark said, sell puts, collect the money, but just be aware of what can happen. And as long as you're aware of that, then there are no surprises out there.
So when someone comes to you at Sogo and asks you about this particular question, hey, John, should I use a short put or should I work a limit buy order? I'm guessing you come down on the short put side of the equation most of the time?
I say that I try to explain that if you sell the put, just be aware of what can happen. That you may own the stock at 590, not at 550. And if you had a limit price in there at 590 before the gap, you would own it at 550. So I just try to educate them, and we always go back to that. And this is the premise of this program, is to educate the customers. When a customer opens an account and any brokerage, there are different levels of approval. I always tell customers, start slow. Level 1 is covered calls. Level 2 is buy options. Level 3 is spreads. Level 4 is naked puts. Level 5, naked calls. So this is the same idea. Just make sure that you go incrementally. You learn. You read Dan's book. You go on our website. You go to the Options Insider. You go to the OCC. Learn about options, and just start small. And it would probably be the ingredients for a good career, a good investing portfolio.
That's a good point. Those approval levels are there for a reason. So you want to use them and take advantage of them. And most brokerage firms, like you said, will start you off with the covered call and the married put, and then kind of start you from there. So we guess we don't have to worry about this for a while, too. People coming in and blasting out a ton of puts. And of course, if they do on level 1, they're going to have, or level 2, they're going to have the cash in their account. They'll have to do cash secured puts, so it won't be as much of a problem. And you're right, John, as long as they are familiar that in this scenario that you and that really G and others have laid out, the gap down scenario, nothing is really ideal in that scenario, but the naked short put could have certain drawbacks in that scenario. And as long as you're aware of that, and limit buy order, same thing, you're not going to get a good fill there either. So as long as you're aware of that, then I think you should be, and you're aware of the potential downsides of doing this strategy and how you're going to actually be executed in these different scenarios, then I think you should be comfortable going ahead and writing these puts, because in the majority of scenarios for investors, like Dan said, it definitely is the preferable way to go. All right, that's going to do it for the mailbag for this week. We want to thank all of you for writing in and for tweeting in and for joining us on the program this week. If you'd like to join us like Alan and Mr. Really G did this week, then by all means, you can reach us a number of different ways. Shoot us an email, questions@theoptionsinsider.com. You can go onto the website and use our comment form there or our feedback form to do that. You can tweet us. We're at Options, or find us on Facebook, Options Insider. There are a ton of ways to get a hold of us here. Shoot us a question and put in the subject line, if you're shooting an email, please just put question for Options Bootcamp so we know which show you're referring to, and if we like it, we'll read it on the air and answer it on the air on the next episode. But unfortunately, that's going to do it for the mail call segment, and that's also going to do it for this episode of Options Bootcamp. But before we go, I'd like to check in with all of my cohorts here, my fellow drill instructors on the Options Bootcamp program, to see what they have cooking in their respective necks of the woods. Starting off with you, Dan. what is coming up in the land of the market taker mentoring?
Oh man, we've got tons of stuff cooking. One is, I don't remember if I mentioned this on the last show or not, but our Market Taker Live Advantage group coaching class has been twice a week for just about a year now. It's become our most popular class, and it's so popular that we decided to take it every day. So now students can sign up and enjoy trade ideas and education every single day for about an hour and a half. We tend to go long, and we're really excited about that. We're actually selling that at our old 2-day week price, which is about half the new value of it. Visit markettaker.com/GC, stands for group coaching, markettaker.com/GC, and get the details.
And Dan promises to wear his hat and his whistle from this show if you sign up for the next group coaching segment. So be prepared for that little treat, listeners of Options Bootcamp. Treat in quotes. And John, what is coming up in the land of Sogo Trade? I know you guys have weathered Sandy, and now you're ready to go, up and running. Everything is running full steam ahead, I should say, over there at Sogo Trade. So what's coming up in the land of Sogo?
I've mentioned this in the past, but we have a new application-based option platform that I've been testing, and we got set back about 2 weeks in the testing because of Sandy, but this platform is looking really good. We're real excited about that, and it's going to be much faster than, other web-based platforms. So that should be, I would say, in the new year. That's going to be coming out. Everyone can follow me on Twitter, Sogo Trade Option, one word. We're going to release our option block soon, and we have many exciting changes in the new year, including webinars, seminars. I can't reveal all the details. But when I can, I'll announce them here first. And it should be a good year going forward for everybody.
And this new platform, this is a standalone downloadable application? It's a standalone web-based application? What are we looking at here?
No, it's an application-based, downloadable, standalone. And what we find is that in the first hour of trading, there is an enormous amount of data that goes through our pipes, or any pipes, millions of messages per second. And so with this application-based platform, it removes a lot of the noise, and we get faster quotes and better quotes and better execution. So we're going to roll that out for our customer base.
I'm looking forward to that. I know a lot of other brokers have done similar things, and it's been a great improvement for their users. And I'm looking forward to seeing what you guys have at Sogo Trade as well, because I know for a lot of our users, the diehard options trader, a standalone application will certainly be something that they will enjoy and get a lot of mileage out of. And if you are out there like Alan and you want to hear more or read more from John, then there's a lot of ways you can do it. Of course, he mentioned you can go over to Sogo Trade, read his educational articles. You can follow him on Twitter, or you can surf on over to the Options Insider. Just search for John Critchley at Critchley. He has a bunch of articles up there outlining some of the things Alan was asking about, some specific trade recommendations and ideas and things you could do in different scenarios. So there are a lot of ways to get more John, if that's what you're looking for, including more episodes of this show, which will be coming out to a podcast player near you very soon. But unfortunately, that's going to do it for this episode of Options Bootcamp. All of us here on the old drill instructor team want to wish all of you out there in the States, and indeed throughout the world, a happy holiday, and we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.